When you finish this video, you will have mastered confirmation entries, which means you will be able to take more winning trades, easily avoid a lot of losses that would have otherwise happened, increase the risk to reward ratios on the trades that you do take, meaning more profit per trade, and ultimately create success in your trading. We're not going to waste any time at all. We want all of this for you in your work. So let's get straight into it. This is what a standard confirmation entry looks like. This one is bullish, so it's for buying opportunities. The first thing we need to see to create a confirmation entry is a market that is downtrending, printing lower lows and lower highs in price consistently. Eventually, we see the market break. We see a BOS, or a break of structure. All this is the market changing from lower lows and lower highs into higher highs. When a higher high prints here, and this area needs to include a closure, a candle closure, not just wicks by the way, this actually validates a change in the trend. Now evidently, with the trend being bearish, a change in the trend turns the impulses of the market into bullish impulses, or essentially means buyers have taken control of this market and it is likely to move up now. When we see this higher high form, we then look for pullbacks into areas of interest such as demand zones. In fact, for every confirmation entry, I use demand zones. We're going to cover those on a real chart in just 1 minute if you need more context on that. And we will enter the trade from the demand zone using a buy limit. So as soon as this higher high is printed, we can actually place a buy limit, meaning when the market hits this level, if it moves to the upside, we'll then be triggered automatically into a buy down here and we'll profit from the movement up. This is the highest probability way to get into positions and provides the best odds of profitability. So now let's go over to a real chart and look at an example. Here's an example of a confirmation entry in a real market. So here we have a market that is trending to the downside initially. You can see that the market is here creating consistent lower lows and lower highs, showing that this is indeed a bearish market or a downtrend. Now eventually the market sees a break of structure which takes place over this high. You can see this is the final lower high in the trend, meaning essentially the final point of which the market was trending down. And after creating this low, which was a significant low, we get this drive to the upside, which has broken through the structure, hence the BOS, and created a higher high. So this higher high here is actually what forms the confirmation. It shows us that the trend has shifted from down to up. Now, as we said, we can use demand zones to place our buy limit. Now, the demand zone in question is this gray candle here. For me, I use the last candle before the impulse. An impulse is a strong bullish or bearish move. Here we can see we have a strong bullish movement. So the last candle before that is going to be this gray one, this indecision candle, this kind of doji candle, or you could call it a pin bar, whatever. It's a consolidation move indicated by wicks before the large drive. So this is the last candle before the impulse. That is what we use as our demand. Now, once this has formed and we have our higher high, as you can see, we have closures above here, right? So these candles have closed above the previous high, not just wicks. If we have just a wick above this level, the probability of it actually leading into a successful trade is slimmer because a wick shows rejections. So if we'd have just created wicks and then started trading down, had we bought here, there'd be a higher likelihood of us moving lower. But because of these candlesticks closing, and obviously in this instance, every one of these candlesticks essentially being bullish, that shows us that buyers are definitely in control of this market. So using our theory of buying from demand, we could place a buy limit order just on the demand level. Generally, because of spreads, broker spreads, I like to place my entry just a little bit above, even if it's just 0.2 pips or so, just to make sure you do get tapped in if the market's precise. Now, for a confirmation entry like this, one of the benefits we get is we can put our stop loss just directly underneath the low. The idea is if the market comes back down to this low, so if we were to see a drive to the downside like this, the trade would be invalidated. So we can put our stop loss pretty much directly under that level, knowing that if the trade does come down to this point, we'd rather just get out of the trade and minimize the loss. Obviously, with confirmations though, we are trading higher probability stuff here, so these will work out and will win a lot of the time. So with your entry on the demand zone as a buy limit order, an automatic buy if the market returns to this level, and a stop loss underneath the significant low of the confirmation entry, your target can then go to wherever you want it to be. In this instance, let's just put it towards this supply zone. This would be a pretty simple place for you to place your target for a confirmation trade. Now we're going to click forward and we're going to see how this trade plays out. and you will see we come down, we get a tap into that demand zone, and then we get a drive to the upside, which in this instance cleared our target. So the confirmation actually took place essentially between this area here, okay? We had a clear downtrend of lower lows and lower highs. We had a break of structure driving to the upside and creating a higher high. Then we have a pullback to the natural demand zone, which is the candle that created this impulsive move, the last candle before the impulse. When the market taps this level, we then see a drive to the upside, which carries us through towards the target that we had set for the position. Now, why do we use demand for entries? Well, a demand zone simply shows us, if we think about what this actually indicates, an area where significant buying has taken place in the past. In this instance as well, very fresh significant buying. Buying that's actually created the shift in the trend that we're looking at just here. This buying, therefore, coming from this level, tells us that this level of demand, this area, this zone, is seen as a discounted price to buy from, or a good price to purchase this asset, whatever asset it may be. The idea is then if the market is able to return to this natural buying level, this discounted price level, new traders, or the same traders who bought here, will be looking to buy once again, because it is a fair price to pay for this asset. So when the market returns to this level, we see the momentum slow down, market taps demand, our buy limit is triggered, and then we see this big drive to the upside. So that is why we look to buy from demand in the case of a bullish reversal. Now, I just want to explain, everything works exactly the same for bearish positions, except we are of course looking for shifts from higher highs and higher lows into lower lows and lower highs. So when the market stops forming these higher highs and instead creates an impulse that drives into a lower low, we then form our bearish confirmation because the higher lows have broken, a lower low has formed, and we can now see that sellers are in control. So the most probable movement from here is to sell from what we would call then a supply zone, which is, once again, just the last candle before the impulse, and in this instance is seen as a premium price to sell an asset. The supply zone is going to be marked just like a demand zone would, but it's the other way around. And when that supply zone is met, it will trigger a sell limit order that we place on or just below that level. Our sell limit order will be triggered, our stop loss will be above the swing high, and in this instance, if we do run nicely, we will get a very solid entry for our position with very positive risk to reward. And if the market runs against us, we'll be stopped out quickly, we can minimize the loss and move on to the next trade. So they work exactly the same for bearish scenarios, except everything is essentially flipped on its head. Confirmation entries like the one we just looked at are best used in context as well. Now in this example, we can see this is a clearly larger uptrending market forming these higher highs and higher lows. We had a break of structure on a high time frame showing us this market is bullish. And then the actual confirmation entry, which took place here, came from an area of demand. You can see just here. So here we benefit from kind of top-down analysis or high time frame and low time frame agreement. The high time frame, of course, as we've just covered, is pointing to the upside. And then what we're doing is looking inside of the pullback move, tracking the lower lows and lower highs that this pullback is forming. And when these lower lows and lower highs shift into higher highs from this area of demand that we've just discussed, this shows us that the low time frame, being this that we're looking at here, agrees with the high time frame, okay? High time frame trend being this uptrend, low time frame trend being the downtrend here, shifting into the uptrend. This context gives us an understanding that we are trading not just in the right direction on this smaller piece of price action, but also in the right direction on this larger piece of price action as well. So let's take a look at some more examples of confirmations in context. So there are 2 points of which confirmation entries can take place from. Number 1 is a reversal, and that's what we're about to look at here. Number 2 is a continuation, which will follow on from this position. So if we take a look at this, what we've seen is a downtrending market here. Our lower high was crafted here. And then the market has pushed up and broken through the structure, okay? So from a confirmation entry perspective, we're starting to see what we want to see. We have the validation up here, a closure, creating a higher high. which means we could now use our imbalance demand to place a buy limit. Now, taking a look through this trend, we see we still have the demand zone that really started to create the first bullish movements. It's going to be this last candle before the impulse, okay? Small candle before a large rally away. And this candle is still not yet retested. So our buy limit, as we've said, can go just on or just above this zone. Our stop loss can go just underneath the confirmation. Our stop loss can go just underneath the swing low of this confirmation entry. And our target will just run it to the actual swing high. Now, when you're taking reversal trades like this, and the reason that this one is a reversal trade, by the way, is that it doesn't really come from any significant areas, right? We're looking at a straight shift from downtrend into uptrend, and we don't have that same context that we had in NZD USD, for example, where this is coming from a demand zone. If we take a look to the left, we see some significant swing lows, and one of them is going to be just here. Another one is going to be just here. You'll see that the market swept through one of them and then made this run away. So we don't really have significant uptrend on this larger perspective. And we also don't really have a significant demand zone or anything that this reaction is coming from. We had a small sweep of liquidity, but nothing really significant. So what we're looking at here is pretty much a direct reversal. Okay, we're looking at the end of a downtrend, the start of an uptrend. We don't have that same context in terms of this being a demand zone retest or anything like that. So for a reversal trade like this, we can actually look to take the targets much higher, because what we're doing here is getting into the start of a new trend. So for the sake of this, let's just set the target to a previous swing high. This downtrend turning into an uptrend, let's just use this swing high for example's sake. We could realistically, if we expected this market was going to reverse a lot further, target potentially even the notable highs, but let's work with this for now. So this is a reversal confirmation entry. We have our structural downtrend here, okay? Then we have our break of structure creating our structural uptrend. Now we are placing a buy limit ready to capitalize on a movement like this, or a reversal in the trend, and we're looking to catch the very start of this trending move. So let's let this market run forward. You'll see from this, we get a run down, a very nice, precise tap in to the area of demand. And then we go and run all the way up to the targets and continue trading even higher. So that is a reversal confirmation entry. We just simply saw the market changing from lower lows and lower highs into higher highs and higher lows. Down here, we didn't really get the significant context we'd want for a kind of continuation trade, because we are just looking at a direct change from down to up, okay? Now, you don't only have to trade confirmations at reversals in the market. If a market has already shifted, like this one, which is now moving bullish, we can use confirmation entries, much like the example on NZD CAD, to take continuation trades in line with this bigger trend, okay? So if we run this market forward, we have a pretty significant drive to the upside here. There's a few areas the market could reverse from. We're always going to be looking for continuations at demand zones. So some of the demand zones I'm looking at here, these last candles before the impulse. As you can see, this instance here, we have final candle, impulse away. Then we have an indecision candle and then another push away. So these are some areas we could look at if the market was to come into them. Generally then, what we would want to see would be that lower time frame or smaller trend being right now the existing trend that's crafting at this point in time. And if we started to see this shifting like so, we could then buy limit to continue taking the market higher. Now the difference between this one and the one we've just looked at is this one is coming from the end of a downtrend. So we're seeing a downtrend end and a new uptrend form. This second trade, we already have the uptrend formed. We already have the movements being in motion, essentially. So what we'd be looking for is just a simple way to join this trend as it already moves, okay? So let's run this market forward a little bit and see how things get on. We see the market coming down towards one of those potential demand zones. At the moment, we haven't really seen anything significant here, right? Why? Because this is our low. We haven't yet created a lower low and then pushed up into a higher high. So this, for now, can just be seen as a consolidation. We would ideally want to see the market coming down and creating a change in the trend and creating a new low before we then started to see a change in the trend, all right? So here we're starting to see something interesting. We've actually seen, at this point, the market come down, and trade into this area of demand. So this is going to be a pretty much significant low. We could look at this kind of structure point, perhaps the previous structure point as well, for some potential levels to break, all right? Now, why would we not classify this as a break to the upside? Well, as we said, this is just wicks. Wicks show rejections, so this movement from here, like so, can't be seen as a confirmation entry at this point, meaning buys wouldn't really be good from there, because we haven't had confirmed change in the trend, we just had rejections. Yes, the market did attempt to go higher, but sellers have pushed it back down. So realistically, we do need to start seeing some of these highs taken out to confirm a change in the trend. Now, at this point in time, we've seen a rally. This rally, after retesting the demand zone down here, which refined to the 30-minute, could be pulled into this indecision candle. This rally has actually broken through a couple of structure points. So we have this structure point broken, we have this structure point, this one as well, and we even actually do have closures above some of these significant higher levels as well. So with this said, we now have, and let's use this level to mark it out, a BOS, or break of structure, where the market has changed from bearish now into bullish. What we can do at this point is find our demand zone and place our buy limit, okay? So, following the same rule, I'm sure you can see where this demand zone is going to be. We are looking for the last candle before the impulse, a consolidation candle, large wicky candle essentially, before the drives away. That's going to be this blue candle here for me. So that is my last candle before the impulse. For this trade, realistically, I don't think we need to go all the way down here with our stop. The shift has happened at this point, so we can just put the stop loss underneath either the notable swing low, which is going to be just these wicks, or if we wanted to be a little bit more aggressive, we could go under this demand. Now this trade for me, I think a good place to put the stop would simply be here. If we think the market is going to get this low, it is then likely to continue going even lower. So it would make more sense to just get out of the trade, call it quits, and take the loss, small controlled loss, rather than let that get out of hand. Because we're in a continuation of an uptrending move, we can just target, as a very simple target, the swing high, okay? Now, if you really wanted to as well, as you can see, you could hold those initial trades for longer when you do get those reversal positions. But this would have been a very healthy profit regardless, even if you'd only taken the market to this level, so there is no harm with this one. And this is just a great way to join in the trends when they are then once again reversing and continuing back in the larger direction. So this is what we call an impulse move. And this is what we call a corrective move, okay? What we're looking for here is just a simple continuation of a new impulse move to take us into new highs in this trend. And this is how we would essentially set the trade up to get into it. So now if we allow the market to play forward, we see a little bit of consolidation. Market comes down towards that demand, and then we see a nice strong impulse away. Now, an interesting thing to note here as well is just how strong this bullish move is compared to the bearish moves that we've seen. And this is how we know we're on the right side of the market. And this is really what we're looking for when we take these continuation trades. You can see that the impulse that started the uptrend from our initial entry all the way up here was very fast and strong. There wasn't really any pullbacks, okay? We didn't really get any slowdowns in the price action. It was just a fast, clear, strong move all the way up. The corrective move was actually then pretty slow, okay? We didn't really do much. We just moved down very slowly. We still kept seeing attempts to go higher from buyers. And then, of course, when we tap into that significant area and we start to see some of those structural points shifting, that creates strength from the buyers. You can see how strong this bullish move is. And then, of course, when we get our tap in, triggering our buy limit, we see a new, very strong move again. So we know we're on the right side of the market here and trading with the real direction of the real trend. So those are the two different places to use confirmation entries in context. We have number one, the reversal trade, where we are simply looking for a downtrend ending. When the downtrend ends, we can then take a position into a new uptrend. A continuation trade will take place when a trend is already existing. In this instance, we see that this is a clear uptrend, and all we're looking to do is use that confirmation pattern to join in to an existing uptrend. Now, I think both are as good as each other. You are going to be able to capitalize more on the full reversal trades because you're getting in sooner. You're getting in right at the start of a trend. But these continuation trades can be very high probability because you're already moving in line with a market that is showing clear strength from buyers or sellers, okay? Now, of course, as we've said as well, these could go both ways. We could have been looking at an uptrend shifting into a downtrend for our reversal trade up here. And then we could have been looking for a continuation of lower price action once the market started breaking lower to get us into a position to trade to the downside in line with the existing trend. That's why we call it a continuation. Regardless, the entry model is pretty much exactly the same. The context of which they occur is the only thing that is slightly different. So that is how we use confirmation entries in different contexts. Now, if you want to learn how I got these results in 2024 and how my students get results like this pretty much every single week that goes by, then head over to the link in the description and you can join my free trading course. It's a 7-part video series which is going to help you to build a system, simplify trading, improve your trades, and find success. The link is at the top of the description for this. It's 100% free, and I will also send you lessons, some of my best lessons, via email for as long as you want me to. I highly recommend you do this. It's going to change the game for you, but if you don't want to do that, make sure you watch this video next, because this is going to provide you a lot of value as well. So thank you for watching. I hope you've enjoyed this class. Go out there and backtest your confirmation entries, and I hope it brings you a lot of success.